emphasize how the machine works. We've created a lot of money and debt, a lot of buying power. Everybody received all that. But you don't create more wealth when you create more money. And we're at the part of the cycle where all those checks went out and all that money came in. And yet before, or just at the beginning of the phase, that all that money is being spent and increasing the inflation. And with it, throughout history, it causes goods, services, and financial asset prices to rise. And so we're in the part of the cycle. We're in the third year. This next year will be the third year in the cycle. And naturally, there will be a tightening of monetary policy. And the problem with that tightening of monetary policy is that there's a great deal of interest rate sensitivity. And because it's gotten so far and so extreme, just the pulling back of that is a very delicate thing. We're in a situation that the raising of interest rates and the tightening of monetary policy begins the process. In the third year of a cycle, as we're in, that normally is not enough to send the cycle down. It could send financial asset prices lower. But I would expect that if you understand the short-term cycle, this typically 7-year type of cycle in terms of expansions and recessions, it's the beginning of the testing of the brakes.
So not necessarily a recession, but could see some increased volatility. You've said you don't want to be in cash right now and you don't want to be in bonds. But if the Fed does embark on this tightening and slows the economy and the markets, that feels like it would be a pretty turbulent time for equities.
The important thing to realize, I think, is that the Federal Reserve and all central banks will have to keep a negative interest rate, a negative real interest rate. Right now, bond yields have, a negative real interest rate of, nearly, 1.5%, 2%, depending on where. And the cash rate is minus 4%. So that all investors will be in a position where the value of their money in cash or in bonds will not keep up with inflation. I think investors need to think about returns differently. I think they look at the amount of the returns in nominal dollars. How many dollars do I have? And they don't look at the amount that they have in relation to real dollars. In other words, adjusted for inflation. And while there can be somewhat of a tightening, it can't be enough of a tightening to raise those returns on cash and bonds to be good enough to compensate for inflation. Because if it is, if you had, that would require a very large rise in interest rates that would first set the economy down. So when we look at the circumstances today, just imagine with the political polarity that we have as we're coming into the 2022 elections and then the 2024 elections, if the Federal Reserve tightened the monetary policy enough to cause a downturn, if we're at each other's throats when these are, everybody's received so much money and this is about as good as you're going to get, just imagine the consequences that would have. So the Federal Reserve, I don't believe, even though they're behind the curve by a lot, I don't believe they're going to be able to catch up and make cash and bonds an attractive investment.